Friday, November 21st, 2:07 p.m. New York time. Welcome back, investors, to Winning Wall Street's Money. If you'd like early access to my videos, well, join my Patreon page. There's a lot more content on my Patreon page that I publicly release on YouTube. This is going to be a learning lesson to some people. I'm going to talk about derivatives and show a trade idea with derivatives. Derivatives on stocks. Forming them are the options market. So I'll give you some history. The key word here is, the buzzword is history. It's in the past. So I'm not going to bore you with too much on that. My options learning was from the official regulatory bodies, not some degenerate group of knuckleheads putting out misinformation that you might see on social media today. My first learning lessons were at the regulatory group at the options exchange called the CBOE, Chicago Board of Options. Yeah. Within them, or above them, physically above them, because I've been to the office of learning there, is the regulatory, or one of the regulatory agencies on options for the CBOE, or options on the stock market. This was in the 1990s when the markets were priced in fractions. Options, stocks, futures, they were priced in fractions. What's also interesting, when I was studying, learning, being taught options from the regulatory agencies, I end up doing my trades at the beginning after I got skill to learn how to trade them. Instead of trading options on stocks, I went over to the futures market, which is the CME, and they also have options. They're regulated under a different exchange and they're structured different. So it was a learning curve. And I started to first trade options in the futures markets on commodities. It was mostly livestock and agricultural. Okay, so that's the history of my options trading. Yeah, it was quite a bit ago when there was dial-up internet. And it wasn't referred to so much as internet, it was referred to as World Wide Web. World Wide Web. When's the last time you heard that? Holy moly. Okay. Let me go over. First to the charts. This example will be with this stock RIG rig. I'm going to show you the basic charting, and then we'll go straight to the options to understand. Oh, let me explain this too about options. Options, again, are a form of derivative. Not all stocks have options listed on them. The board members, CEO, get to decide if they want their company that's on the stock market they get to decide if they also want to have options trade on. Understand that? But also the regulatory agency has to approve of it. Not all stocks have options on them. Some companies wait till years down the road. And it used to be when you did an IPO, initial public offering, you couldn't get your company on the option market till after a year. Now it's even faster. What, it's a few days, a few weeks? I think it's a few days. How things change. Yep. That being said, I'm going to give you an example on options. Houses, homes, automobiles, vehicles, they have, for the most part, has insurance on them. I don't know why you wouldn't. Understand? There's insurance agent, insurance broker, insurance company. So I'm going to use the word company, insurance company. You buy auto insurance, you buy it from a company. You buy homeowner insurance, you buy it from a company. And the contracts are typically for 1 year. And then you're making monthly payments. They're called premiums. You hear that keyword? Payments, premiums. You're paying a broker a fee, a premium for that assurance. The insurance is collecting. The insurance company is collecting that premium. So they receive a credit. You're paying it. It's a debit. And you understand that momentarily when I get to the options. So there's two sides of the option market. There's the person that's paying for it, aka buying it. They're paying for the premium. That's a debit. And then there's the person receiving it as a credit. Yep, in the options market, you could be on either side if you want. That's a beautiful thing. And since they're contracts, they have expirations. There's some assurance premiums that are for 1 week, 1 month. When you travel, some people buy assurance policies for traveling, maybe for 1 month, for the hotel, cruise ship, Airbnb, just for examples. Same in the options market. There's different durations. Some are a week, some are a month, 3 months, 6 months, 1 year, 2 year, 3 years. Yeah, I know it's a lot of information. This is the basic, but I'd rather give you the bigger picture than maybe add more confusion when you hear one word and then see a lot more choices on it. So that being said, options, assurance, they have expiration dates on them. There's different durations. The longer you buy the contract for, typically the more you're investing in it, the more you're paying for it. Hopefully you got that. That's some basic information. Options also, just like stocks, Forex, crypto, futures, there's bid and ask. There's market makers. There's a lot of participants. And there's regulatory agencies. We'll get to that again more, the option charts in a minute. But here, we're looking at RIG, currently at $3.88. Literally, almost, yeah, it's a penny stock. When it's below $5, it's a penny stock. Can you say that, please? Let me hear you say that. When it's below $5, or when it's $5 or lower, it's a penny stock. That's the regulatory agency in the stock market that classifies that. So RIG here on the far right, I'm going to update this because last week it did make that new high. $4.39. There you go. Zoom out. Far right, weekly grid. The current candle will be done at 4 p.m. New York time today. That week would be done. Yellow horizontal line is the high of the year. The bottom horizontal line is the low of the year. So again, last week we made a new high for the year. Since then, we made a lower high, lower low. So the trend reverse is trending down. This big green candle is a key level that I decide is a key level. It's midpoint of that big green candle. For me, it's a potential trade out there. It hasn't gone in there yet. Down here, this green area is another demand zone where buyers were. And look, they made that huge, strong impulse move candle up. Again, strong buyers came over here. That's why I have that labeled. So pull back in these areas, I would be considering to take a trade. I'll be using lower time frames to look for a single and an entry. Again, this is my setup, but that alone, it's not my single and entry. I'll be using lower time frames. Middle grid, daily. So here, these orange horizontal lines is gapped. It gapped up. It hasn't even tested that yet. This big green candle, midpoint. It's been acting as a demand zone. You can see back here. Buyers are stepping in. And look at this. Today, we did a deeper dive. Again, we almost broke below this demand zone. Buyers are already stepping in here. Yesterday was that huge sell-off, panic selling, dumping, more bearish bias, and buyers stepping in here. Me, I'm not looking to buy here. I'm not bullish yet. Again, I'm just seeing again the higher time frame, the weekly. The trend is down, lower low, lower high, red, red, red. Daily chart, again, we had that huge move down. We might see a bounce, a midpoint test. Now, I'm not day trading it. This is not my type of financial instrument on day trade. I trade derivatives, leverage products, more buying power, more potential return, specifically the futures and options talking about. Yep. So there I'm labeled midpoint. And daily chart. You see yesterday on the far left, the 30-minute chart. You had that panic selling yesterday, extended hours in this dark gray area, and lower. We haven't even taken out this. This was the pre-market on the far left 30-minute chart. This was the pre-market high. We haven't even taking it out yet. Again, showing signs of bearish. It's just being lured into pump, dump. Again, this stock is not NVIDIA. It's not Apple. I'm not expecting it to go $100. I'm not expecting it to go $50. It's certainly not 100,000 like some crypto. Nope. Short-term trading duration. I have alerts set. It hasn't hit those. So now let's go to the option chain. Yeah, this desktop trading platform I'm using is called Thinkorswim. It's owned by Charles Schwab. Just a minute. Let me get to my sippy cup. So now we're on the, excuse me, different tab on the desktop trading platform. Top left is rig. Again, the stock's $3.885. Yeah, way too many numbers on the far right. That's not a good thing. So bid and ask right here. The bid, the ask. $3.88 for the bid. The ask, $3.89. Volume, 29 million. That's outstanding. That's huge volume. The spread between the bid and ask are good. It's 1 penny wide. That's very good. You even have stocks that are really high priced, several $100s that are not even that good. But the bad thing is, again, when you start having more numbers, more than two numbers after the decimal, yeah, that's not good. Explain that further in other videos. So again, this is level one I just showed you. I want to show you options. So these are contracts. See on the far left, contracts. Just like I told you, insurance policies have contracts. Some are for maybe 1 month, 1 week, 1 year. Well, in the options market, you have many contracts offer. So again, this one expires today. See this one that says 21 November? That expires today. This will expire today at the close of the stock market, 4 p.m. There's another contract, 28 November. That has 7 days right here in parentheses. And look all the way down here. You have a contract. See this 21 January 28? Again, that's the year 28, 2028. Yep, you can trade contracts all the way out that far. Not all stocks have options. Not all stocks that have options have this many durations of contracts. Depends if there's an interest in them, do they create them? And these yellow ones are the weekly ones. So again, different durations. Got it? So I'm going to show you a little bit more here now. Just going to open up a random one. Let's open up the one that's 20 February 26. Again, February next year, 20 February expires. I'm going to open this up more. No, yeah, let's just put it on 10. There we go. Right here, the word strikes. I'm showing you 10 strikes. Right in this column, strikes. We already know the contract is 20 February. And they all have how many days they expire. So when you hear the word DTE or read the word DTE, days till expiration, say it right or get out of the kitchen. Too many people that are not well informed make mistakes and they don't own up. Put misinformation out. Again, I wish more people would go to the regulatory bodies and learn the legit language, the legit information, instead of confusing more people. And not all brokers offer options as a trading asset. So again, I'm going to show you some basic stuff here. If you open up a broker to trade options, I highly recommend you make sure it's in the United States. Make sure you're a stockbroker, futures broker, crypto broker, Forex brokers in the United States. I say that because I know many people up to this point in my life that opens accounts with other countries and they got locked out of their accounts, and the U.S. Justice Department, U.S. court system does not regulate brokers in other countries. So again, 20 February, 91 trading days. The left side here is calls, and the right side is puts. This is an option chain. Okay, so I have several columns in here. I could change these, but this is what I have right now. In the middle of the strikes. So we know the stock's $3.89. So if I go to these higher strikes, they're considered out of the money. Again, the fourth strike is above the stock price. That's out of the money. And if I do a strike price at the money, which there are none, if it was at the money, it'd be $3.89. Got it? Now, in the money is any strike below 389. Well, 350, 3. This is on the call side I'm referring to. It's the inverse. So on the call side, out of the money strikes anything above the underlying and add it, which there is nothing. Yep. So calls are just like stocks for the most part. If you're bullish, speculating the stock's going to go higher, you'd be buying calls. If you're speculating the stocks go lower, you would short the stock, or you could buy puts. Again, if you think the stock's going to go lower, speculating the stock's going to go lower, you either short the stock or you buy puts. If the stock goes lower, you start seeing gains. If you don't close your position, those gains could be lost. When you close your position, it's either going to be closed for a win, a loss, or profits. So again, if you think the stock's going to go higher, you could buy the stock. You could buy a call option. If the price goes higher, you have gains. To have profits, you have to close it for profits. Again, the bid and ask, 1 penny wide. So the nearest strike is 4. 4, strike 4. Look at the bid and ask here. The column bid, 40 cents, and the ask, 46. That's 6 pennies wide. So in reality, if you don't know, options contracts in the stock market are equivalent to 100 shares. These are leveraged products. Leveraged products derivatives. Yep. So 100 shares, each contract controls 100 shares. So 100 shares times 42 cents is $42. That's a wide bid and ask. Now let's go on the put side. The 4 strike. Look at this, 48 on the bid and 65 of the ask. That's wide. That's bad. Yeah. Another column here. See this column that says volume? This is how many contracts traded today. Some are opening, some are closing positions. So I'm showing you 10 strikes. I'm going to take it down just to 6 strikes. Now we're on 6 strikes, only 6. So you see the column that says volume. Look at this one that had 207. So this had the most volume of contracts that were traded. Somebody might have done 1, 2, 3, 5, 10. Somebody might have done 200 contracts. Someone else might have done 3. Someone else might have done 4. Doesn't mean it was all done by one person. The point is, now that I'm just showing you 6 contracts. Sorry, 6 strikes. 6 strikes. The one with the biggest volume is this one, the 4 strike on the call side. Let's go to the put side. The put side, the 4 and 350 had the most volume. So obviously there's more volume on the call side than the put side. Now we're going to go to the column called open interest. See this column says open interest. That means how many contracts have traded and are currently open since the contract was created. This has been created quite some time ago. So after the market closes, the next trading day, which would be, because today's Friday, the next trade would be Monday, this open interest would be updated. So if these are all purchasing, this 207 shares are purchased, then this higher would be number. If some of these of the 207 are closing positions, then this number would be reduced. Got it? Yeah. So look at the open interest. Even though this 4 strike has the most volume today, it doesn't have the most open interest. This one does. The 3 strike on the call, 3 strike. And let's go on the put side, open interest. This one's got over 20,000. That's a 350 strike. Yep. Again, I'm going to do this more now. I'm going to open up the 14 contracts. Now we're looking at, 14 strikes, 14 different strikes. This is Thinkorswim, again, owned by Charles Schwab. So look at here. The open interest, and then some of them had no volume today. And then on the far right puts, you can see a lot of them had no volume on the put side for, again, the 20 February contract. Or gets the other ones that have more. Let's open up this 21 November that expires today. Yep. See the volume, just basic information. Okay, I want to show you something else now. Options, times, and sills. I'm going to close the option chain, time and sill. I have this queued in for the stock rig. It's showing me only today all the activity on options today, all the trades for every single, again, I'm going to open the option chain, for every single contract that's available, if any of them have trades today, opening positions, closing positions, they are here. So the far left is the time. Next column is the option contract, the quantity. Yep. Now I'm going to show you here today in the morning, because this was interesting. It'll also give me an insight of what I think is happening. 10:06 a.m. Again, New York time, 10:06 a.m. The contract 20 March 26. So again, this expires next year. Somebody did a trade on a contract that expires next year in March. They did 250 contracts. Again, one trade. That's one trade on that, 250. And the price, 20 cents, aka 100 contracts, $20. I know that. That was at the bid. Remember, there's the bid and the ask. So again, see right here, the market price was 2022, 2 pennies wide. Yep. And again, wide, look at the bottom number, or the number on the left, 2022. Got it? So when it's red, when these numbers are red, it typically gets filled at the bid. When it's green, it typically gets filled at the ask. So one of two things happen here. They either shorted the call option, they either shorted the put, sold naked puts at the bid and collected $20 for each contract. So that'd be credit. And that being done, they'd be speculating the stock's going to stay above $3. But that's so far out doing that. Again, each has their own mindset for doing things. Or they had a current position and they closed it. Okay, because it was dead at on the bid. So again, they either shorted the put or they closed a current position that they were in. We're above it now, 10:21 this morning, same, 10:21 this morning. The contracts that expire this month, the 28th November, on the calls, 350, the strike, 3.5, 3.5 call. Somebody did 1,000 contracts. See the price, $31. Again, it's red, and it was at the bid because the bid is there. So again, someone either shorted call options, that means they're bearish, and they would have received a credit of $31 for each contract. Yeah, 1,000 contracts, $31 for each. Or if they're not shorting it, then they're closing the position they had open prior. But the point is, both of these were done on the bids, and there's two things on the bid. You're either closing a prior position, so if they bought in the past, put or call, it doesn't matter if they bought a put or a call in the past, when they bought them, if they bought them at the ask, and when they closed them, again, we don't know if they did this days ago, weeks ago, but if they bought them at the ask, then they're closing them at the bid, then these would be closed out and then that open interest be lower. But if they shorted them today, that means either they sold call options and received $31 for each contract. Again, that's a bearish strategy, selling call options, or they shorted the put options. That's a bullish strategy. Got it? That's the biggest activity today. I'm going to show you something else, then we're going to reduce this. Oops, first we're going to do the 20 March. So 20 March. There we go. So we're looking at the 20 March puts. All the trades today on the 20 March contract, on the puts, again, I showed you the largest one is 250. Everything below it is lower volume. Got it? So here's all the time they went off. And these are all trades. The second biggest one, again, was at 10:06, 125 contracts traded. The price was 20. Again, so that was at the ask. So if they bought puts, they paid $20 for each contract. If they bought puts, they're bearish. They're expecting the stock to go lower. If you sell a put, you're bullish. You're expecting the stock to stay above your strike. Just very interesting. And they might have broke this down to smaller amounts to mask. And so whoever's doing that one side might also be doing the other side, but masking it by doing smaller orders. If you look at the strikes. Yep, interesting. Again, these are different exchanges, the options you trade on. See, CBOE, NASDAQ, NYSE. And again, they probably masked it on different ones. Just interesting to see. But either way, that'd be interesting if they're hedging, maybe. Don't know. So let's now look at the other one. The 28th November. And their calls. Let's do the calls. There we go. And this large one, that was 1,000. And let's so again, all these other ones are different strikes. Same contract, but different strikes. So let's just focus on the 350 strike. And we'll exchange up or leave it like that. There we go. Again, so now we're getting 28 November contract, 3.5 calls, all the trades that were done today. Okay, the largest one over was 1,000. Let's close that. The second largest one was 75.75. So majority of them, see a red? So majority of them were done at the bid. So again, they were either shorting the contracts because they're bearish, they're expecting the stock to go below 350 between now and that expiration, or they're closing positions they had before and buy them back. So if they're closing them, buying back, that means more likely they were shorted them at a higher price. Example. So this one that says 25 November, 350 call, they might have shorted the 350 call when the options were at, let's just say 50 cents. Who knows what day. But if they're buying them back today, then they would have made $19 a contract times 1,000. So that's $19,000. Got it? Yeah. This alone is not going to have me trade mirroring their things. Nope. Just sharing some insight on options there. Well, actually, let's do this too. Let's go to the one more thing. Go to the option chain. We're looking at 28 November. 28 November. Right there, we're going to open up 28 November and 350 call. Let's just do this to 8. Let's lower it to 6. There we go. Let's lower it to 4. Now we're looking at four strikes. The 3, 350, 4, 450. Again, we're doing the contract. The ones that had the most volume today was the 28 November. And that's what I have queued in here. 28 November. 7 trading days till expires. And the 350 call. So again, a strike 350 on the left side call. Look at the volume today. 1,262. So we know of that volume today, 1,000 of those contracts was all done by one individual. The other 262 was, let's cue this in now. Again, sorry. Call 28 November and the strike 350. There we go. So all the other ones, remember I told you there's 262. Man, one trade was 1,000 contracts. The other 262 were broken down all these other traders. So these other trades would add up. But again, I show you these 2 other ones, the 75. Wow, interesting. So let's look here again. One more thing here. 350 strike, today's volume 1,262, but the open interest 930. So right off the bat, that's going to tell you the open interest is lower. So come Monday, this open interest is going to actually be a higher number. Sure, 930 of these might be closed today, but again, this number is bigger than that. So that being said, you can subtract 930 if that's how many are closing today. But again, this number will be updated Monday, and they're not all being closed. But there's more volume today that's already there. And look at here on the 350 on the put side. Volume today, 7. Yep, open interest, 423. Interesting. Okay. Wow, look at what here on the 30-minute chart. Now it's run back up to that pre-market high on the 30-minute chart on the far left. Opened it up, knocked it down, jumped it. It already broke by 1 penny. The pre-market high. It's right there. It was at $3.91. Was it? Yeah, and it was the same thing. Yeah, interesting. Yeah. Again, showing my charting, some reasons why I'm not looking to trade it right now. Nope. I'm bearish bias of stock short. Might have a bounce, go up here. My strategy is, again, if we get a single on these, again, my setups are here. I just showed you these setups here on the weekly chart and the daily chart here, my setups. And when it comes to those prices, I'll be looking for a single, candlestick single. And if I take the entry, my plan is to sell naked puts to receive a credit. And don't know when that's going to occur. And when that occurs, I'll be looking at the option chain, selling naked puts. Those say hypothetically, between now and some other time, I'll be selling naked puts below the strike. On the put side, shorting puts, receiving a credit. Stock's at 388. So if the stock was at $4, I'll be looking for a strike below it. And there's a certain dollar amount I want to receive. Again, you can play with these numbers. Thank you as always, spending just a little time with me. That's it for the video. Thank you for watching.